August 30th, 2023. Something that's important to keep in mind on trading range days is magnets. And I, drew them out. The 3 high is a bad signal bar. So, you think we're probably going to test it. The 9 low is a bad signal bar. And so you think we might have to test it. You can see when we did, we started to find sellers. Something else that's interesting too is like I say, 90% chance there's a breakout of the 18 bar range. That's one of my favorite statistics to use from Albrook's whole methodology. And you can see we failed to break out of the 18 bar range on bar 37, and we got a big bear bar on bar 38. This was a tight bull channel, so it made sense that we were probably going to go a little higher and make it up past this high. But after bar 38, bulls most likely are just going to scalp at the high because this really damages the chances of us getting a big swing up. It was unlikely anyways because of this, and this wasn't the strongest bull channel. But when you get an II at 35, 36, bulls were hoping this was the start of a new trend, not a final flag. And you can see bar 38, big bear bar. So a lot of those traders now disappointed. Anyone who's buying here now disappointed 38, sees 39 and 40 as a chance to scalp out at that new high, knowing that we're probably still going to this high because we're going to break out of the 18 bar range. Bulls, some bulls will buy the close of 38, hoping we get a bull bar and hoping they can make it up to that high. So they're essentially trying to make, essentially a 5 point scalp, and most of them would have stops, maybe I would say probably below 38, knowing that if we trade down here, that you're just basically hoping for the bull inside bar on 39, which is exactly what we got. And you can see on bar 51, that's a bad signal bar, and a trade went that, traders who bought below 51 should have made money. And you can see they were let out on 64, and that's where they were selling. And 61 wasn't a bad signal bar, but it was a swing trade, so it wasn't, super high probability. You can see we tested it on 77, as we normally do with these things in trading ranges. Some traders would argue, so I'll just start. So bar 1, bull bar closing near its high. Bar 2, trades below 1, probably buyers below. Then you get an inside bar on 3. It's a double bottom with 1, a potential swing up. Whenever you have a buy climax, like the day before, yesterday was bull trend day, so it's a buy climax on the daily chart. There's a 75% chance of at least 2 hours of sideways to down trading and of a starting by the end of the second hour. So you got to keep in mind that it's probably not going to be a bull trend today. Some bulls would argue that you have an open body gap with the 75 close and the 1 open, which is true, it is. And so when you get bar 4 and bar 5 as follow through, and then 6 creates a gap with 4, you now have 2 open gaps. And so if you're a trader and you see this, the small piece of you should be wondering if we're going to have a bull trend day today, because there is still about a 25% chance of that. It's low probability, but it's not no probability. So you kind of have to keep in mind that it's possible that we do end up having a bull trend day, but you should be pretty suspicious of, this looks like it's just 1 push up, 2 pushes up, 3 pushes up, and a wedge, which is what it ended up being. But when you see, bar 3 and you get 4 and 5, you got to be thinking that traders who sold the high of 3 are probably going to get out at break even. And anyone who buys below 9, once you get 10, is probably going to get out of break even. Why? Because it's a trading range day and gaps fill and traders get let out of break even. And so surprise on 5, follow through 6, yes, but disappointment on 7. And this tail is disappointing. These tails are disappointing. These tails are disappointing. So not as strong as it could be. Inside bar on 8, potentially a micro double top, and a failed breakout essentially on 9. And once we got 10, traders pretty much agreed that we're going to get to the 7 high and probably close this gap. And we had already closed this gap. And so a lot of traders will sell the close at 10, betting that 11 and 12, basically we're just going to get vacuumed down to to close that gap. One of the ways you want to trade trading range days is find spots where there are potential vacuums, which are just really fast moves, essentially, like 26, 60, 63 is just a vacuum of 51 low. So you want to find those spots where, you're buying, hoping there's going to be a vacuum rather than buying the top of the vacuum as some sort of buy the close bar, which it is, but it's not a good idea on trading range days to take those kinds of trades. So 10 and 11, I think, good pair of bear bars potentially sell the close, but there's a really important question that you have to answer is once we go below 2, our bulls going to be able to buy more lower, 5, 6 points lower, whatever, and make money. You can see they're able to buy below 2, buy more lower, and they make money on 13. So once you see 13, you know that it's probably not a bull trend day because of this, and it's probably no longer a bear trend day because of this and this. So that what does that mean? What is it probably? A trading range. And if it's probably a trading range, where are we probably going? The 9 low. So you have to keep that in mind. Some traders argue that the 12 close was not never tested. And while that's partially true, you can see that anyone who sold the close of 12 was disappointed in 13, probably also disappointed that 14 was a really strong bar that let them out. So some of them started to buy back their shorts around, with a small loss. But other traders, they see the close of 12. They see that 15 is a potential double bottom, but it's not a very good buy signal bar. So they'll sell above 15, and you can see that's where 16 and 17 went to. So traders who sell here sell more above 15, and they're getting out around break even. And them getting out around break even is the reason why there's a lot of buying down here. Some bulls, that's the bears buying at least, and bulls would be buying because we have this big bull bar and they're hoping to front run a double bottom. 17 is an interesting bar. You only have 2 bull closes in the past 8 bars, and you're following basically a tight trading range, and you're probably buying high in a trading range. But 17, if you're buying, you're kind of hoping it's going to do what 26 did, and you're going to get a bull bar that vacuums you up to the 9 low. And you can see if you bought above 17, you get 18, but 18 is kind of deceptively disappointing. There's a little tail on the top, which is a problem. And if it's so obvious that it was obvious once you get to close of 10 that we're getting to the 3 high. We're probably getting here too. That's why you get such a big bar on 11. Once we got 24, 25, it was pretty obvious to traders that we were getting to the 9 low. So you get that vacuum up. If you buy above 17, you're hoping it becomes obvious that we're getting to the 9 low, and you get swept into a big bull bar, and you're able to, get a pretty quick scalp at the 9 low. But 18 is not really what you're looking for. You wanted a better bull bar, you wanted a bigger bull bar, and you wanted to get out of this trade within a bar or two. And so a lot of traders, when they see this disappointment, they kind of just sell out, knowing that the pullbacks in trading range days can be extremely deep, and they don't really want to, have to sit through a really deep pullback like 19. So bulls start selling out of their longs, basically assuming that, the vacuum is not as high probability as they thought, and we get a big bar like 19. 20, bull bar tries to test the 18 close, isn't quite able. Anyone who bought, the 18 close is obviously extremely disappointed in 19, and they're looking to get out. So a lot of them sell it during 20, maybe 21. You can see 22. It's kind of 2 legs up. 2021 first leg, down on 22, up on 22, second leg. And so probably sellers around the 18 close during 23. You can see 3 pushes up. So potential wedge at 23, but probably not. It's a potential bear flag. And so you have to keep in mind that we might get a measured move down if we break below it, or if we break above it, we could get a measured move up. But it's not all that likely that we're going to get a strong move in either direction. I think the 9 low is more important than any sort of, measured move magnet at the time. So 24, it's a potential breakout of the bear flag. Get follow through on 25. For a lot of bulls, that was enough confirmation that we were breaking out of the bear flag, and there was a couple points left to scalp to the 9 low. So they took the buy, and they get out during 26, 27. 28, bear bar, but after 3 straight bull bars, probably buyers below 27. And you can see bulls took the buy, and they know they're going to be able to buy more lower, get out around break even, which they were able to do. 30, this is really sideways trading. It's kind of hard to want to trade anything in here. It's always in long, and it's a tight bull channel. So that's something to keep in mind. So if you're going to do anything, probably buy. But something to keep in mind is that when you're in tight bull channels, none of the buys look all that good. And by the time it starts to look kind of okay, like 36, it's probably more of a final flag. And so I don't really think I would be buying. I don't think I would want to necessarily buy in here, because you're also kind of towards the top of the trading range as well. So sideways, essentially, bulls look at it as 3 pushes, slightly sideways to up pullback. 34, bull bar, but probably getting back to the 33 high. We do end up having an open body gap here, and we had another one here, but these gaps are probably going to close. And like I said, 36, potential final flag, follow through 37, but couldn't quite break out. And then you get a big dump on 38, disappointed traders that we couldn't break out, and traders selling the top of the sell climax, which is obviously going to be resistance. So then when you get 39, traders know that because of this, it's pretty unlikely that we're just going to start rallying. So they sell out of their longs at the new high, get a double top on 40. I wouldn't sell below 40. You're potentially looking at a midday reversal, but it doesn't seem all that good. If this closed on its low, maybe it's a little better, but it's still a tight bull channel. So I'd rather wait for follow through. You do get some follow through on 41, but now you're right on the moving average. And I don't think I want to sell right on the moving average. I'd rather wait to see if we get another bear follow through bar or see if we start to reverse up and then get another chance to sell. 42, it's a high two, but you're at the top of a trading range. It's not that good. If you bought 42, you want like extremely fast follow through, and you're just really almost never going to get it. 43, so bad follow through, not surprising. 43, 44, again, potential, triple top. You could look at it as that. It's getting confusing though, trying to count the legs in here. It's better to just assume trading range and wait for a breakout. 45, probably buyers below, probably sellers above. You get to 47. 47 is interesting. It's a third push down, essentially. You could argue it's a fourth push down. And when you get bars like 47, 48, I generally assume we need one more leg up. And the reason for that is because it's parabolic. So if you look on like a 2-minute chart, so we're looking around 125, 120. So 120. You can see, this is a pretty parabolic drop. Like I guess bar 48.6, the bar counter gets screwed up on different time frames. But you can see if you're just like, this is the channel line, you start to get a parabolic breakout of it. And occasionally that parabolic breakout will go, but it usually doesn't. And it usually ends up getting a bounce. And, I think that was one of the trades that's really, really hard to weed out because it looks really reasonable and it definitely works sometimes. But 48 is a bar where you need one more bar or you want to bounce and then a second reversal down. So it's okay to wait for the one more bar. But the problem with trading ranges is a lot of times when you get the one more bar, it's a really big climactic bar and then you get trapped out. 49, big bull bar closing your tie. 50, some follow through for the bulls, but not all that much. Inside bar 51. And then you get 52. I think the context for selling below 52 is really good. It's unfortunate it doesn't close on its low, but I think it's still reasonable to take the short and, maybe look to get to the 19 close. That's actually almost exactly where we got. If you're aggressive, you can hope we get to the 12 close, but you probably have to get out above 57. You definitely have to get out above 61. So follow through 53. Some bears, get pretty quick, pretty much 5 points, right? Yeah, some bears get a pretty quick 5 points to bar 54 and they just scalp out, causing a reversal up on 54. Bad follow through above 54, so you get 55. Obviously, it's, after this is enough for a second leg. So, low probability buy above 54. I did sell below 52 and I took most of my trade off below 54 during 56, thinking that strong bulls know that this reversal is not good to buy above, but strong bulls will start buying below, betting we're going to form a double bottom of some kind at some point down here that they're going to be able to make money on. And that's why it's important to think about the other side. Because if you're trying to make money, I'm trying to think of the right way to phrase this. If you're short and you're looking to buy back your shorts, you should find out where strong bulls are also buying, because where strong bulls are buying is where you want to be buying. It doesn't matter that if you're buying into longs or scaling, exiting shorts, you're buying regardless. So you want to find out where the strong traders are buying, which is probably below 54. Some smart bulls will start scaling in and they'll be buying there. So 55, 56, follow through for bears could just be 2 legs down and you get a big bull bar 57. I think shorts probably have to exit above 57. You have to be pretty aggressive to want to stay in after that, because, you got to think about your risk here. You could definitely get a big follow through bar and, bulls won't buy above it because you usually don't get a pretty parabolic follow through bar, which is pretty much what you need there because your risk reward isn't all that good. And so it's lower probability. So you need really fast follow through. And this happens a lot. But the reality is, if you're staying short here, you're trying to just scalp out around the 56 close or maybe at a new low. And then 58, 59, maybe 59 is a final flag. 3 pushes down and an inside bar, potential short. So anyone who sells below this probably just trying to get a scalp below 57 low. And you can see that's where bulls bought. So bulls buy here, they're buying more lower, hoping for a reversal up, which is what you get on 61. I think 61 is a reasonable buy. It's a wedge bottom. It's okay to take it. We have that 51 low magnet. So I think it's okay to buy and look for that low. And you can see 52, 62, some follow through. if you didn't buy above 61 and you're staring at 62 thinking, oh, I really wish I had bought above 51 or above 61, you can just enter at the market and put your stop where you would just treat it as if you had bought above 61. It doesn't matter. As long as you understand how you're supposed to manage that trade, uh, and you manage it the same way, it doesn't really matter where your entry is. So if you see 62 forming and you're disappointed you didn't get in right here, just buy at the market. You can see on the close of 62, a lot of traders just immediately bought, hoping that, knowing that 61 and 62 is enough for a second leg. So even if we go down, they'll be able to buy more lower and get out around break even with a profit on their first or second entry and break even on their first. Or we just get vacuumed up to 51 low and they're going to make money. And that's exactly what happened. And you can see on 64, potential bull trap, but after 3 straight bull bars, probably not that good. Second leg up, 60, 65, 66, 67, and a low 2 short at 68. But it's pretty late in the day. This is pretty strong. I would pretty much just let it go. The odds of a big move up and a big move down immediately, the odds of basically this happening again aren't all that great. And you get kind of bad follow through, and we kind of have an expanding triangle to the close, but just a trading range. Something that's interesting to do, when you get days like yesterday. So if you look at bar 7 yesterday, that's essentially how the bar closed on the daily chart. And so you can look at the follow through that bar 7 got yesterday, which is kind of disappointing follow through, smaller follow through. And a lot of times after those climactic bars, you get smaller follow through. So I would encourage you, as you get better at reading price action on a 5-minute chart, to look at the daily chart and use your knowledge of how trades work on the 5-minute chart to use for the daily chart, essentially. So you can get a bias for the day, essentially what you think is going to happen. Coming into today, you have to be open to anything, but are we going to get a big bull follow through day? Probably not. Are we going to get a big bear day? Probably not. It's probably going to be a trading range. You can kind of do the same thing here. You get the 24th. Is tomorrow going to be a giant bear day? It's unlikely. Is it going to be a giant bull day? It's unlikely. Trading range is likely. So, doing those little things and helping eliminate, certain possibilities or just realize that they're less likely will definitely help your trading. Yeah, that's the day.